Okay, in this segment, we're going to talk about make or buy decisions. What we are talking about here is insourcing, which is our make, or outsourcing, buying from another party. All right, so outsourcing is purchasing goods and services from outside vendors, where insourcing is us producing the goods or services within the organization. Now, in Chapter 11, regarding insourcing, we are going to keep this very simple. But in one of our later chapters that we're going to see at the end of the semester, we are going to consider what is called transfer pricing. And transfer pricing is where one specific division within the corporation or organization makes the product or service and provides it to another part of the company internally. And when this occurs, transfer pricing and tax implications need to be considered. But again, for our use in this particular chapter, we are going to keep it simple. But I do want to let you know, just to introduce the fact that this could actually be more complicated than what we are going to see here, because we could have to consider such things as tax implications. All right, we need to make the decision. Do we want to continue to make a product ourselves, or do we want to outsource it and buy it from another company? There are all kinds of factors that need to be considered, not just our quantitative, monetary issues. What can we make it for per unit versus what can we buy it for per unit, and considering other relevant information cost-wise in the decision. But we should also keep in mind our quality standards, our delivery time, and other such issues that could arise if we buy from another company. We have got to be able to depend on them and the product or service that we are outsourcing from them. We are also going to consider in this particular segment opportunity cost. We will see how to calculate opportunity cost, but also how to use it in our analysis. Opportunity cost is the contribution to operating income, which is revenues minus variable cost, foregone by not using a limited resource in its next best alternative use. So an opportunity cost is us giving up an opportunity to do something else with our capacity, and therefore also giving up the opportunity to make some additional operating income. And we're going to see how we can use opportunity cost in our analysis in one of two ways in order to help us make our decision. In our particular scenario, again, we're trying to decide, do we want to make an item ourselves or do we want to buy it from someone else? Typically, our rule is going to be that we need to select option A or B, dependent on which one is going to cost us the least amount of money. Of course, that in turn is going to make us have a higher profit if we go with the one with the lowest cost to us. We're treating this just the same as the special order. We're trying to maximize our operating income. So let's take a look at our example. We have got a product that we can produce ourselves. It costs us $36 per unit in direct materials, $10 per unit in direct labor, $6 per unit in variable manufacturing overhead. We also incur some mixed manufacturing overhead in order to produce this product in-house. We've got a flat $750,000 or fixed $750,000 plus an additional $625 in setup costs per batch. And in order to generate 250,000 units, we would have to make 2,000 batches. So 2,000 batches times 625 equals 1.25 million. We add that to the 750,000 and we've got a total of $2 million. Now if we take that 2 million and divide it by the 250,000 units, that means our mixed manufacturing overhead is $8 per unit. We also have fixed cost of $3 million. And that $3 million, if we were to spread that across the 250,000 units, would be $12 per unit. Okay, so if we were to take all of these costs and add them together, we would be able to calculate $72 per unit for us to make these in-house. 72 times 250,000 means $18 million is our total for making these ourselves. Now, we can actually outsource these with another company. And this other company will do them for us at $64 per unit. Now, as I've mentioned earlier, if we were to just do a rough look at everything, we would look at this and go, oh yeah, we could save $2 million by outsourcing these. Let's do it. But no, we've got to look deeper. These fixed costs are $3 million. Are we going to just be able to snap our fingers and eliminate $3 million worth of fixed cost for the manufacturing plant and the other related fixed cost? Absolutely not. Okay, so we need to consider how much of that can be eliminated, if any. Okay, if we can't eliminate any, then this $3 million is going to be an expense or cost to us. All right, so this 18 million versus 16 million is not really giving us a clear picture. Okay, it would be more like saying 16 million plus 3 million equals 19 million in order to buy them. 19 million is $1 million more expensive than the 18 million for us to just make them ourselves, right? So we need to analyze the numbers, figure out what's relevant, and evaluate. All right, so if we buy them, our unused capacity, the capacity that we've been using for these 250,000 units, is actually going to sit idle, and we, under this particular scenario, are unable to eliminate this $3 million worth of costs and expenses for it. All right, so this $3 million will still be incurred. We will be able to save $750,000 in fixed salaries that were supporting materials handling and setup. Those are not going to be incurred. And then we've got those other variable costs that we are also not going to be incurring. So we must compare our relevant info between the two alternatives. Do we want to continue to make? If so, how much does that really cost us? Or do we want to buy them? And if we buy them, how much is it really going to cost us? Not just what we're going to pay the other company, but anything that we are still going to have to incur regarding our original capacity. All right, so we could lay it out like they've got here in the text. Again, here are our relevant costs. If we purchase them outside, we would pay $64 a unit times 250,000 units, which equals 16 million. And then here are our internal costs to make. Our direct materials is 9 million. Our direct manufacturing labor is 2.5 million. Our variable manufacturing overhead is 1.5. And then our mixed cost is a total of 2 million. Now this is based off of those per unit numbers that we showed on a slide earlier. 36 per unit for direct materials, 10 per unit for the direct labor, 6 per unit for the variable manufacturing overhead. We've got those batch costs for the materials handling, which was the $750,000 plus the $625 per batch times 2,000 batches. And then we had a total of $3 million for fixed manufacturing overhead. But notice that the $3 million is not showing up here. Why is it not showing up here? The $3 million in fixed cost is going to have to be covered whether we make them ourselves or buy them. Okay, so we don't even have to show it on here. Okay, notice that if we did, this one would have said a total of $18 million, and this one would have totaled $19 million. And we would see that to buy would have been more expensive than to make, which we are also still seeing here. Okay, so instead of seeing 19 versus 18 and $1 million cheaper to make, we're seeing 16 versus 15 and still $1 million cheaper to make. Okay, so we can eliminate use of the irrelevant, $3 million because it has to be covered under both. It does not differ amongst the alternative like these other ones here. All right, so again, it's all about setting up the problem, what information needs to be considered, what is irrelevant, what can be ignored. What if that idle capacity could actually be used for something else? We might need to look into that. All right, so let's consider buying our part one from somebody else and then using that capacity that we would have used for making part one and instead make part two and sell that to our customers. What would happen? All right, so we would need to set up an analysis and calculate what is the overall effect on operating income. All right, we would need to look at product number two and say, what could we get for it in revenues and what is it going to cost us to make them? All right, in our text, we're looking at our product number two and saying we could generate $8 million in revenues. The cost to make product number two is a total of $5.5 million. And therefore, if we subtract our costs from our revenues, our operating income can actually increase by $2.5 million. Well, that may actually make this decision help us out. If we buy elsewhere and use that capacity to make product two that's going to help our operating income, that may offset some of that additional cost, right? So should we outsource item one and make and sell item number two? That's the question. We have two different ways we can set this up. We've got one called the total alternatives approach, and we've got another one called the opportunity cost approach. The only difference is how the numbers look. In one of them, we're going to subtract that increase in operating income. And on the other one, we're going to add it to our cost to make. Okay, that's the only difference. All right, so taking a look here, notice again, we're ignoring the $3 million in fixed costs because it is going to be a cost for us that will be incurred above and beyond our variable cost per unit. Under our total alternatives approach, notice that we are seeing the $15 million of the $18 million in total manufacturing costs if we make the product. Under column 2, we are seeing the $16 million which was the $64 per unit that we could purchase them for, times the 250,000 units. But notice how we're subtracting the additional operating income from making product number 2. All right, so the $16 million in cost is being subtracted or decreased by that $2.5 million in operating income to show us that the cost here is in fact cheaper. $13,500,000 is cheaper than $15 million. We would be better off to buy product 1 and make and sell product 2 because it would be cheaper. Okay, that's what this one is showing us. We can also look at it from, again, the opportunity cost approach where just like you looked at in some of your earlier lower level classes, opportunity cost can be added to your make decision, because opportunity cost, again, is you are giving up the opportunity to make an operating income. Okay, so you're giving up the opportunity to increase operating income. So look at that increase in operating income like it's a cost. Okay, so that $2.5 million in additional operating income that we're going to give up if we continue to make our product gets added to the $15 million. Okay, so $15 million plus the 2.5 equals 17.5 versus the 16. Again, the 16 is just the $64 per unit times the 250,000 units. Here's what it would cost us to buy, and here is what it would cost us to continue to make. Again, the $3 million is the same under either one. Okay, so we don't even have to put that on here. This is just showing us that if we continue to make, it is actually going to not benefit us or cost us $1.5 million more than if we use that capacity for product 1 to make product 2 and generate more operating income. Okay, so looking at these differently, this one is going to cost us less than this one. Okay, and this one cost us more than this one. So this one's cheaper. This is the route we should go. This one is cheaper. This is the route we should go. Look at how those are laid out. That's the only difference. So we would definitely want to choose alternative 2. So again, opportunity cost, how you deal with it makes a difference. In my opinion, pick your method and go with it. On your homework, you may see where you might have to work the problem both ways, but when it comes to passing a certification exam, my suggestion is pick the route that goes best with how you think about it and use that method. So opportunity cost is that contribution to operating income that has been foregone or given up by not using a limited resource in its next best alternative use. Opportunity costs are not recorded in financial accounting systems. There are no journal entries for this because historical record keeping is limited to transactions involving alternatives that managers actually selected. Okay, so if it didn't occur, it does not get journalized. One type of opportunity cost that many times gets considered out there is the carrying cost of inventory. If we have lots of inventory, it has got some serious carrying cost. We've got money tied up in the inventory, but we also are paying for storage, possibly extra utilities, security, all kinds of other things that come into play in holding on to inventory. All right, so we would need to consider the cost of carrying that inventory sometimes in some of our different scenario analysis. Don't forget about the qualitative factors. There are many non-quantitative factors that can be extremely important in evaluating our decisions. Quality requirements, we have made reference to the fact that many times there are specific and very detailed specifications that may need to be met. Those things need to be evaluated, checked into. You also, of course, would need to check into the background or the reputation of who you are considering as an outsource. There are lots of companies out there that do rely on outsourcing. Your textbook mentions Toyota, but I can tell you for sure that here in Chattanooga, Tennessee, Volkswagen Corporation definitely has a multitude of suppliers that they are depending on in order to keep their operations up and running. And I'm not just talking about the other suppliers around the Chattanooga area and over there in Enterprise South. I'm talking about their international resources. For example, a friend of mine has worked in their procurement department at Volkswagen, and I can assure you that not only do they send out their engineers well in advance of contracts and purchase orders being issued, they also send out their procurement people. So they will send their procurement folks, their engineering, their quality control out months in advance to meet with these vendors, potential vendors, and they will be evaluated on their products, their pricing, whether or not they can meet the standards, whether or not their delivery is reliable, etc., so that Volkswagen can make sure they choose the resources that are going to be able to help them make their product on time and be of the best quality continuously. Employee morale, of course, also needs to be considered. This is another one of those qualitative factors that's very hard to measure. Think of eliminating the workforce that was originally making product one. If you decided it was honestly cheaper to let that go idle and buy that product elsewhere, you may still have fixed costs to cover, but you would eliminate or pink slip your workforce. How is that going to affect employee morale? What if you still have employees working in another particular area within your company and they have to watch all their friends in the other area leave? That will definitely do something to the employee morale, and we have definitely experienced this many times over the years, especially here in the Chattanooga area, being that in the past we have relied a lot on manufacturing. We used to have such plants as the U.S. Pipe and Wheeling Foundry, just two honorable mentions over there on Broad Street, past I-24 at the foot of Lookout Mountain near Broad Street where those plants used to be. And they are no more. And there used to be employees by the thousands here in Chattanooga that worked at those two plants. And they are no more. Logistical considerations, distance from plant. Okay, not only are we talking about things like fuel costs and transit time, but what other kinds of logistical nightmares could occur. So things like that have to be considered. If Volkswagen cannot get their seat belts or their steering wheels on time, somebody's going to have to go slap the big red button on the wall and stop the assembly line. That's a problem. Okay, so things have to be considered. So outsourcing is very risky. A company's dependence on its suppliers increases. Suppliers could increase prices. They could let our quality and delivery performance slip. We need to be very ticky about our long-run contracts and being very, very detailed into specifying our costs, the quality we expect, the delivery schedules, etc. Again, procurement and engineering gets in on this information well in advance. This stuff has to be under control, and you've got to make sure and choose good sources. Consider how risky that is in sourcing internationally. There's some other things that come into play with sourcing internationally. Not just these items here on the list above it that we've just discussed, but also consider the fact that not everybody is using U.S. dollars. Okay, so if we're going to be buying from Mexico, we've got to consider that foreign exchange rate from U.S. dollars to pesos. A company could enter into a forward contract and purchase pesos in advance to help with anticipating the effect of that exchange rate. We could enter into that forward contract to help us out with that, or we could be at risk to what that exchange rate would be whenever that invoice would become due and payable. So there's a lot of things that have to be considered in outsourcing.